Welcome back to the Explainer. So, in our last session, we were firmly planted on the left side of the balance sheet, right? We walked through every asset line item, looked at the current versus non-current split, and tackled some tricky valuation concepts like depreciation. Well, today, we're shifting gears. We're heading over to the right side of the balance sheet to figure out exactly who has a claim to a company's resources. We're talking liabilities, equity, and the key terminology that really ties the whole shebang together. Okay, here's our game plan for today. We're going to cover the fundamental skills of accounting, the ticking clock of liabilities, the residual pie of equity, and finally, the key diagnostic terms that banks and investors actually use to measure financial health. Let's get into it. First up, the balance sheet scales. We need to link those assets we talked about to actual obligations and ownership. So, to balance the scales, every single asset a company owns had to be funded by someone, right? And that brings us to the strict, undeniable mathematical truth of the accounting equation. You usually see it as assets equals liabilities plus equity. But if you flip it around so it reads equity equals assets minus liabilities, it honestly tells a way more compelling story. It shows you the residual value left over for the owners. The true net worth of the business is literally just what you own minus what you owe. Think about it. If your liabilities are growing faster than your assets, well, the owner's slice of the pie is shrinking. Moving on to Section 2, liabilities, the ticking clock. This is all about present obligations. All right, by definition, a liability is a present obligation to transfer economic value to another party sometime in the future. It's simply what the company owes. And here's the kicker. The 12-month threshold is the ultimate dividing line. It's what separates short-term urgency from long-term structural obligations. Current liabilities? Those are due within the next 12 months, meaning they demand immediate cash or resources. Non-current liabilities? Those are due after 12 months. Let me tell you, getting this split wrong will completely distort how investors view your immediate financial survival. Let's group together those immediate obligations. We've got accounts payable, unpaid supplier invoices, accrued liabilities, like unbilled wages at the end of the month, short-term debt, and corporate taxes. But look closely at deferred revenue. This is cash you've already received from customers before you've actually delivered the service. Imagine selling a 1-year software subscription up front. You've got the cash today, sure, but you still owe 12 months of actual service. So it's a true liability until you actually do the work. Okay, I want to pause here for a crucial insider tip because, honestly, this is where so many reporting mistakes happen. Let's say you have a 5-year term loan. That's long-term debt, right? Well, not entirely. Every single reporting period, you absolutely must update your debt maturity schedule and carve out the exact amount of principal payments that are due in the next 12 months. That specific amount has to be ripped right out of the long-term bucket and dropped into current liabilities. If you skip this step, the consequences are severe. You'll end up overstating your long-term stability and dangerously understating your immediate short-term risk to anyone reading your balance sheet. Don't let that happen. Now, looking beyond that 12-month window, we hit our non-current liabilities. This bucket holds the remainder of that long-term debt, long-term lease obligations, and long-term deferred revenue for multi-year contracts. But notice deferred tax liabilities on this list. Because of the temporary differences between standard accounting profit and taxable profit, usually driven by things like accelerated depreciation, you're going to owe taxes in the future. And the rules specifically dictate that deferred tax liabilities are uniquely always classified as non-current. No exceptions. We also see provisions sitting here, which are estimated obligations we'll unpack in just a minute. All right, Section 3, equity, the owner's claim. This is all about the residual interest in the company. Once that ticking clock of liabilities is totally handled, we finally arrive at equity. This is the residual pie that truly belongs to the owners. And here's exactly how that pie gets sliced. First, you have share capital. That's the money originally invested, recorded at face value. But if a company issues a $1 par value share and an investor pays $15 for it, that extra $14 drops directly into additional paid-in capital. Next, we have retained earnings, which is just the running total of all the net profits kept inside the business over time. We also track specific unrealized gains and losses in a bucket called Other Comprehensive Income, or OCI. And finally, pay attention to treasury stock. These are shares the company actually bought back from its own shareholders. It acts as a reduction, sitting in equity as a negative number and actively shrinking the total equity pie. Let's look at the retained earnings roll forward, because this builds into one of the absolute most important checks in all of accounting. You take your opening retained earnings, add the net income generated this period, which comes straight from your income statement, subtract any dividends you paid out to the owners, and boom, you land at your closing retained earnings. It's a bridge. And let me be clear. If these steps do not reconcile perfectly every single period, something is fundamentally broken in your books.
Let's move to Section 4, Financial Health and Valuation Terms. Time to open up the diagnostic toolkit.
Understanding the numbers on a balance sheet is great, but knowing the terminology that analysts use to evaluate those numbers, that's what separates basic data entry from real financial analysis. These core metrics help stakeholders answer some massive survival questions. Take liquidity. That measures how quickly you can convert assets into cash to pay off short-term debts. Working capital is just your current assets minus your current liabilities. If that number is negative, you've got a major liquidity problem on your hands. Solvency looks at the bigger picture. Do your total assets exceed your total liabilities? A solvent company can pay all its debts if it had to liquidate tomorrow. And then banks are going to closely watch your current ratio, which divides current assets by current liabilities. A ratio above 1.0 means you've got enough short-term assets to comfortably cover your short-term obligations.
Now, when assessing the actual value of these line items, you absolutely must understand the difference between carrying amount and fair value. Carrying amount, or book value, is strictly what's sitting on your balance sheet right now. Think of a factory's original cost minus years and years of accumulated depreciation. Fair value, on the other hand, is reality today. It is the actual price you would get if you sold that asset in an orderly transaction on the open market right this second. The balance sheet relies heavily on carrying amounts, so you have to remember that the book value of an asset might be vastly different from what someone would actually cut a check for today. To round out our vocabulary, we have a few very strict valuation rules you need to know. Provisions, like a warranty or a pending legal claim, are liabilities where the exact timing or the exact amount is uncertain. But you can't just guess and slap them on the balance sheet. No way. They require 3 strict criteria. A present obligation must exist, it has to be probable that money will flow out, and you must be able to reliably estimate the amount. Then we've got deferred tax again. Remember, always non-current. And finally, goodwill. That's the premium paid when acquiring another company. The key rule here? Goodwill is never just steadily amortized over time. Instead, it has to be tested at least once a year for impairment, just to make sure the value of that acquisition hasn't permanently dropped. So we've completely mastered the components now. We know the assets, we understand the ticking clock of liabilities, and we've sliced up the equity pie. But as we look ahead to our next explainer on actually preparing the balance sheet, I want you to ask yourself this. You know the ingredients, but how do we practically assemble, reconcile, and verify all these line items flawlessly, every single period, without making a single structural error? Well, that is the exact puzzle we are going to solve next time. Thanks so much for joining me, and I'll see you in the next explainer.